In the world of investing, few voices carry more weight than Charlie Munger. At 101 years old in December 2025, he has more than 70 years of market experience. He bought his first bank stock in the 1960s, lived through the savings and loan crisis of the 1980s, survived the 2008 financial meltdown, and watched hundreds of banks disappear. When Charlie Munger speaks, serious investors listen. What follows is the fully reworked, analyzed, and greatly expanded version of a private warning Charlie Munger recently delivered to a small group of investors. In it, he explains why he believes we are heading into a banking crisis that could rival or exceed 2008, but this time concentrated almost entirely on regional and mid-sized banks, not the giants. Charlie Munger does not predict the end of the world. He simply says, if you own shares in any of the three categories of banks I am about to describe, sell immediately. Otherwise you risk losing everything. Section 1, The Big Picture, Why Now? As of December 2025, the U.S. banking system stands at a crossroads. The megabanks, J.P. Morgan Chase, Bank of America, Wells Fargo, Citigroup, have been stress-tested to death since 2008. They have massive capital cushions, diversified portfolios, and sophisticated risk systems. Charlie Munger sleeps fine about them. What keeps him up at night are the regional and mid-sized banks, $100 billion to $1 trillion in assets, that are sitting on a toxic mix of rotten commercial real estate loans, hyper-concentrated deposits, often inexperienced or aggressive management teams. Current data, December 2025. National office vacancy rate, 20.7%, San Francisco 33%, New York greater than 20%, J.P. Morgan, CBRE. $936 billion in commercial real estate loans mature in 2026, plus 18.6% versus 2025. Office loan delinquency rate, 11.76%, TREP, worse than 2008. 59 of the 158 largest banks have CRE exposure greater than 300% of equity, Florida Atlantic University. Regional banks hold 67 to 70% of all U.S. commercial real estate debt. Charlie Munger's favorite line, financial crises don't happen all at once. They build slowly, then all of a sudden. Section 2, Category 1, Banks loaded with commercial real estate, CRE. This is the most obvious and most dangerous category. Charlie Munger. Office real estate is undergoing a permanent structural change. Remote and hybrid work has killed demand. This is not cyclical, it is over. Companies have learned they don't need nearly as much space. Employees have proven they can work from home. The old everyone in the office 5 days a week model is dead and buried. Consequences. Property values down 40 to 60% in major cities. Rental income often cut in half. Loans taken out at 3 to 5% between 2010 and 2022 now maturing at 7 to 9%. Owners are handing back the keys, jingle mail, rather than throw good money after bad. Mechanics of collapse, Charlie Munger's classic example. Regional bank, $10 billion in assets, $1 billion in equity, 10% ratio, looks healthy. 30% of loan book equals CRE $3 billion. 20% of those CRE loans default, recovery 50 cents on the dollar $300 million loss. Equity drops from $1 billion to $700 million 7% ratio. Depositors see the losses panic withdrawals bank sells bonds at a loss more losses death spiral. Real-world examples, Charlie Munger doesn't name them, but we all know them. A California bank with greater than 40% of its book in San Francisco offices capital ratio down from 9.5% to 7.2% in 1 year, deposits down 15%, stock minus 60%. A Texas bank that lent aggressively in Houston and Dallas drowning slowly. Charlie Munger. I'm not predicting. I'm observing. The losses are already there. They're just hidden by extend and pretend. Regulators are now forcing banks to face reality. When they do, many will discover they are already insolvent. Red flags: check quarterly 10Q per 10K filings. CRE loans greater than 20% of total loans. Red flag. 30% mortal danger. Heavy office or retail exposure. Tangible common equity ratio 40 to 50%. If multiple boxes are checked, sell today. Section 3, Category 2, Banks with hyper-concentrated deposits. Charlie Munger. A 21st century bank run doesn't take days. It takes hours. You move millions with 3 taps on your phone. Historical example: Silicon Valley Bank, March 2023, fine on Wednesday morning, dead by Friday morning. Same scenario possible today with crypto-focused banks, cannabis banks, entertainment industry banks, LA/New York, private banks for ultra-high net worth clients. Charlie Munger tells an old personal story. Many years ago we invested in a small bank that looked solid. But a huge chunk of the deposits belonged to one very wealthy family. When that family got into a spat with management over something trivial, they pulled every dime. The bank almost didn't survive. I learned the lesson the hard way: deposit concentration is an existential risk. Red flags. Website and marketing clearly targeting one sector. Very high percentage of uninsured deposits, greater than 50 to 60%. Deposits swinging wildly quarter to quarter. Branches clustered in one niche geography. Brokered deposits greater than 15 to 20%. Hot money that vanishes at the first whiff of trouble. Charlie Munger. I wouldn't touch a crypto bank with a 10-foot pole. The risk-reward is insane. Section 4, Category 3, Banks with weak or inexperienced management. Charlie Munger. In banking, more than almost anywhere else, management quality is the difference between survival and extinction. A great manager can navigate almost anything. A bad one can sink even a fortress balance sheet. What Charlie Munger looks for in bank leadership: real experience through a full credit cycle. Bone-deep conservatism: the best bankers say no far more than they say yes. Skin in the game: personal net worth heavily in the stock, bonuses tied to asset quality. Strong, independent board. Disciplined capital allocation: building capital in good times, not paying it all out. Real examples Charlie Munger often cites. A CEO he met in 2018 to 2019 who was already pulling back from CRE while everyone else piled in. Today that bank is thriving. Another CEO who always sounded like a salesman, endlessly optimistic. His bank is down 70% and on the brink. Charlie Munger. The best time to judge bank management is during the good years. The ones who stay disciplined when everyone else is reckless are the ones who will live. Section 5, When all 3 risks overlap: near certain death. Charlie Munger. The most dangerous bank of all has 40% office CRE, most deposits from real estate players, and a young, aggressive CEO who has never seen a downturn. That bank will not see 2027. Section 6, Why hasn't it blown up already? Charlie Munger. Banks die slowly, then all at once. Problems are hidden, loans are extended, regulators give time. But one day a big loan defaults, a big depositor leaves, a news article appears, or examiners dig deeper, and it's over in 48 hours. Section 7, The cheap bank stock illusion. Charlie Munger. Many look at these stocks trading at 0.5 times book and think bargain. Wrong. When a bank is distressed, book value means nothing. Assets are worth far less than carried. I saw it in 2008, banks with positive book turned out to be completely insolvent once marked to reality. Never catch a falling knife in banking. Section 8, What you must do right now. Charlie Munger's final, uncompromising advice. If you own any bank that checks one or more of the boxes I've described, sell today. Do not negotiate with fear. Do not wait for a better price. You can always buy back later when the dust settles and the survivors are obvious. But if you stay in and the bank goes to zero, you will have nothing left to take advantage of the opportunities that always follow a crisis. Charlie Munger's recommendations. Exit the 3 deadly categories immediately. Rotate into the giant, diversified banks. They may drop, but they will live. Or exit banking entirely and go into tech, healthcare, consumer staples, or plain cash/T-bills at 5%. Keep plenty of dry powder. When the storm hits, the bargains will be legendary. Charlie Munger always ends with the same line. There is nothing worse than watching a stock you own go to zero. It's not a 50% loss. It's the permanent, total destruction of your capital, and the emotional pain that comes with it can cripple your judgment for years. Protect your capital first. Everything else follows.